So first thing which we are going to prepare is our fixed asset schedule. Fixed asset, you create a separate sheet, and you should remember that most of your, how to say, inputs are on this assumption sheet. So we have been given that our fixed asset, estimated fixed asset is 90, 100 or 110. And we need to, when I came to this sheet, I put this also here, fixed asset, and I put it here like 90, 100, and 110. But if you pay attention, I did not type it, I just link it so that any change which we make here, it will be automatically reflected here. Why I put it here? I put it here just to, keep it in front of your eyes so that you do not lose sight. You actually can just remove it, you can ignore it, but I'm just putting it here. And I'll put my useful life also here so that I see these things here. And let me link this also from here to 10 years, this one. So this is also linked to that sheet. So changes will be made in assumptions. All things will be connected. Now, in most cases, when you start making investment, let's suppose that it is going to be 100 million. Do not assume that all of that 100 million will be spent in year zero. It does not happen because probably this is some part where you start the production, and because in reality what happens that the businesses cannot wait to start production because the investors have already invested money and they want their return as fast as possible. So it is possible that you have set up the facility and your finished good warehouse is still being constructed. Some part is done, some is remaining, and some of the equipment, some related equipment is coming, but production equipment is there. It is possible that your, some kind of, how to say, renovation works are, office building is still being there, but production starts, and office building construction or some renovation is being there. So because investors, they want to start very fast. So it is very common that projects, they keep on investing for the first 2-3 years. So I assume that in year zero and in year one, that whatever we decide, like 100 million, let's suppose, if that 100 million happens, 80% of that will come in year zero and 20% will be invested in year one. And by the way, you should remember that year zero is never it is not 365 days. Year zero is the investment period. Year zero could be your, 1 day. So today you make investment, it is year zero. From tomorrow, year one will start. So when you start doing business, year one starts. So year one starts with your operations. It is possible that year zero is 18 months. Year zero is 18 months. So this is the period in which you are making or setting up your facility. And when your operations start, the day your operation starts, you come into year one. So let's suppose if I am purchasing, if I'm making this DCF model for a fleet of cars, I'm purchasing 5 cars and I want to start a rent-a-car business. So I don't have to manufacture cars. I will pay the money, I will get the cars today, and from tomorrow, I'm starting renting out these cars. From tomorrow, these cars are available. So today, just in 1 day, the year zero will finish. It could be just 1 day, as little. And from tomorrow, when the cars, they are available for operating activities, you start doing your year one. So first thing about year zero. So year zero is my preparation time, construction time. 80% of the investment will be done here. 20%, the remaining little things, I will put it as I'm doing my operations. I'm still spending on my CapEx. For example, you are putting some plantation in your production facility. You are making some greens. You are making some, maybe your proper cafeteria, maybe any other things, which usually are done later on. And then it is not possible that you do not invest later on. You keep on investing throughout. I mean, there will be a little bit of capex throughout the life of the project. So you can assume that 3%, 3%, 3% based on the nature of your equipment. You know how much capex it requires because you keep on changing the parts, you keep on, and not like the small parts which come in maintenance, but on upgradation. You keep on upgrading. And probably at the end of 5 years, there is some major upgradation. So 10% capex is done in the year 5. And then again, 3%, 3%. It again, all is my assumption. You will have your real life assumptions, whatever they are. So these are your assumptions about investment plan. And then you have your beginning PPE during the year, and you have to choose them here. So what we are going to do, we are going to take the same formula for cases, like we will go with our choose formula, which we used before, and we come back to our assumptions, and we will say that this is one, which is our case one. And then the three options for investment are 90 million, or probably 100 million, or probably 110 million. And you close it. So because we have taken there, our assumption was case one. So let's make it case two. Let's suppose if I go to case two, it is already 100 million. But we said that not all of that will be spent, 80% of that will be spent. So what I need to do, I just need to multiply this thing with this 80%. So it means that 80 million of investment will be done in your first year. It is also a very good idea that if you want to have output, you can just divide it with 1000 so that the numbers, they look much cleaner. I mean, that is your presentation style. You can remove it, you can keep it. It is 80 million here. And then in year two, how much are you going to have? So what we can do here, that we take this number and we just, this much I will do F4. This I can take my, the dollar sign on this one, and on this one, and on this one. I'm just locking the cell references. So when I put it here, it makes 20 million. So out of 100 million, what I did, that if you notice that this one I put $2 sign because this is my index. Index was case one, case two, case three. So I don't want to move those cells. That is a specific cell. I don't want to move it. But for these ones, I just put $1 sign with the column, which means column should not change, but rows will change. 36 for the best, 37 for the most likely, 38 for the worst. And you just put $1 sign, okay? This was, you should be careful. But here I just locked the cell because this was case one. I don't want to move this cell downward, okay? This cell will be static, but these will move down as per the choices. So we come here, this one, and then 3% of that, you've got your 100 million, because we picked up 100 million as our base case two, which is your most likely. 3% of 100 million is 3 million. So 3 million is going to be your capex during the year. So in year zero, you spend 80 million. In year one, it is 20 million. And then moving forward, it is 3 million, 3 million. And then here it is 10 million. These all are the workings which your production manager has sit down with you and the production team has given you. This is typically the job of the production manager. They will tell that how much maintenance and the capex will be required. Being a finance person, it is not my job. So, and production people, where do they know that? Because your production manager has experience before. He has been working in past in your company or in any other company. He knows that. Plus you get this information from your supplier of the equipment. The manufacturer of the equipment, they tell you that how this plant will be upgraded or how much you should be needing it. So this is the provision. These numbers, I am not taking it by myself, like sitting on my computer, I just assume numbers. These numbers you should have taken from some proper source, because ultimately these numbers, if I make it 2%, it makes a big difference. It's $1 million. I just make it 3%, it is a $3 million. So it's not funny. I mean, I cannot make it 5% and it makes 5 million. These are, I mean, these are serious numbers. And I have to justify these numbers to the board. When you will present the model to the board, they would ask you, where did you get this 3%? And you should have an answer for that. You cannot say that I just assumed myself. There is no assumption such as like this you can make. So then you have to calculate your depreciation. So in year one, what will happen? In year zero, there is no depreciation because year zero, there is no production going on. So year zero, there is no depreciation. We just make a total. So my ending PPE was 80 million. So this goes as the opening PPE for the next period. I take it. So now in year one, what I have opening PPE coming in from year zero, 80 million plus 20 million I spent there. And then I need to calculate depreciation. Now, because we assume that the plant has a life of 10 years, so we can depreciate at 10%. And what we do that in year one, we will take the depreciation of the previous period, okay? I will take depreciation, I will take my this number, and then I can say divide it with, actually I should not be charging depreciation in this here. Let's calculate. I have kept a schedule at the bottom. Let's kept because here it will be too complicated. Let's start keeping calculating depreciations below. For example, in this period, year one, you will have depreciation of this and divided by the 10 years time. So it gives you 8 million of depreciation. And what you need to do, that you just have to lock the cells. So come here and just press your F4. The $2 signs will come, and I also put F4. With F4, it will, lock the cell and lock the row. So the cell is locked. And then I can just drag it because this investment has been done, 80 million in year zero, and in the next 10 years it will be depreciated like 8 million, 8 million, 8 million. So this is the amount here. In year two, now you have two types of investment. One, which is this one, which is already here, and the second is the additional investment which you have made. So I come back here and I take this 20 million and the year one number. By the way, pay attention, I'm doing the previous year, divided it with 10. And again, I will do F4 here and F4 here. So this is 2 million, like 20 million. So 10% of 20 million is 2 million. And I take it there. Then similarly, I come to year three. In year three, I will take year two number, divide it with 10, and just make your F4 and F4, and you've got, take this 3 million divided with 10. I make F4, here it is F4, and 300,000. Because it is 3 million, so depreciation is just 300,000, 10 years. And you can just take it like this. It will take a little bit of time. Now I can go fast. You already know what to do. So I will not speak all of them. I'll just do that. And in this year below, I'll take my previous year divided by 10, F4 and F4, and done. And in this period, this is a very typical way of calculating your depreciation and amortization, by the way, because it helps you. Now, there are some things which I will explain you. I will explain you about the life, because what is happening, that some of the things will not be fully depreciated because you will take them in this one, this one, and this one. And then I come here in this period. So this 3 divided by 10. Give me a minute, please. I'll just complete. Otherwise, I will make a mistake, because when you are doing some numbers, you need to keep your focus. Otherwise, sometimes what happens that while listening to music or talking to someone, you just pick up some wrong numbers, and then it takes ages to correct. And the last one also. I'll take this one. F4 and F4. Let me make the total. So the total depreciation in year one is 8 million, because in year one, you had only one investment, which is coming from the past. In year two, you already have this much and this much, and you can take now totals of that. So for 10 years, you've got total. Now, what you should understand, or probably you would be thinking, that this is exactly depreciated as 8 million, okay? And because we did it for 10 years. This one we only, because we stopped it at year 10. So there are 9 depreciations. For this is 8 depreciation. For here, for example, for this much, there are 7 periods, 6 periods. And here there is just 3 years. I mean, you've got 30 million here. Why you just depreciated for 3 or 4 years? I mean, if you pay attention here, this is the depreciation which is coming in from this period, okay? If I double click here, it is coming in for this period, for this one. So this is only 300 plus 300 plus 300, 900,000 has been depreciated. Whereas we said that we need to do depreciate over 10 years. So where is the remaining? The remaining is in the residual value, because you suppose that 20% of the plant will have a residual value. And that's why you have a residual value, because at the end of year 10, some of the assets, they have been fully depleted, they have been fully depreciated, they don't have any value, but some assets, they do have some value. And that's why we supposed in one of our assumptions that your plant will have a 20% residual value. So not all of the assets are fully depreciated on one single day. When you are closing your business, it is possible that there is some asset which you just purchased in the January of the year 10th or in the February of year 10th. And at the end of year 10, you have to stop the business. So this asset will not be fully depreciated. And because of these such assets, you will have some residual value. And now we take the depreciation numbers. We take this one from here, multiply with -1. So this is the depreciation for year one coming in and for the other periods. And when you make a total of this, so you've got a closing value of 9.2, and then you can, take it like this, and you can copy paste this much also. So you've got your ending PPE. These are your depreciation and amortization figures. These numbers we needed. So we needed this depreciation number because this is something which is going to give us the tax benefit. We will show it in our income statement or in our, coming to our EBITDA or EBIT. We will conclude it. We will include it as our expense, and it will, decrease your tax liability. So therefore, although depreciation and amortization is a non-cash item, we are preparing a cash flow statement. So when you talk about cash flow, what depreciation has got to do in that? It's a non-cash item. Yes, it is non-cash item. 8 million is not going to decrease my cash, but this 8 million is going to give me tax benefit because I will show it as an expense, and then as a result, I will pay lesser taxes. So it is going to create a positive cash flow for me. And I can tell you how much. In year one, if I've got this 8 million, I can say that this 8 million multiplied with 30% because my tax rate is 30%. Because of this depreciation, 2.4 million of tax benefit I will get. And tax benefit means that you can consider it as your cash inflow. This is what we are going to do it in more detail. When the time comes, when I will make the sheet, I will show you how to show this tax calculations. So if you are clear on this, your fixed asset schedule, we can continue forward. Any questions, please ask. We actually have taken our 100 million, this one, because we went for, if we go back and see, so what numbers do we have? Let's keep this number 8 million in your mind, okay? So if you go back to your assumptions and you say, no, assumption is like selected case is the best case. So in the best case, you come back and now this is 7.2 million because your investment has gone down. Because in best case, the model has already picked up with 90 million, not with 100 million. So it gives you flexibility. You just have to make like the worst case thing. The worst case was the maximum investment. The maximum investment, it already took 110 million. So 110, and then 80% of that, 88 million here, 22 million here, and similarly the depreciations again from 8 million to 8.8 million. So this is like picking up or making your fixed asset schedule and your depreciation and amortization thing. So this is done. Now let's move to the next section.